Welcome to Unit 2 Agricultural Business Management. In this lesson, we will discuss Introduction to the Financial section, Building from the Ground Up, the Foundations of the Farm Finance, and Advanced Financial Tools and Analysis. Well, understanding finances is not just for accountants or bankers. It's a core skill for every agricultural entrepreneur. Whether you are running a small family farm or managing a growing agribusiness, knowing how money flows through your operation is essential for making informed decisions, avoiding unnecessary risks, and planning for long-term success. Financial literacy allows you to see beyond day-to-day transactions and understand the bigger picture of your business health. By learning how to interpret financial statements, manage cash flows, and assess profitability, you gain the tools to respond confidently to challenges, secure funding when needed, and invest wisely in growth opportunities. In today's fast-changing agricultural sector, this knowledge is not optional. Instead, it's a critical advantage that empowers you to build a resilient and sustainable enterprise. For these reasons, the financial section is structured into two parts. Part 1 represents the foundations of farm finance. So this part is designed for readers who may have no previous experience with financial terminology or tools. It focuses on the essential financial skills you will use regularly to manage the day-to-day finances of your farm. Using plain language and practical examples, it explains core concepts such as budgeting, cash flow tracking, and simple financial statements. The goal is to build confidence, help you to understand where your money goes, and ensure you can make informed decisions that support financial stability in your daily operations. Well, Part 2 presents advanced financial tools and analysis. This part builds on the basics and explores more advanced tools you will use less frequently, but which are of course crucial for making strategic decisions and long-term plans. Here you will learn how to interpret financial ratios, evaluate solvency and liquidity, and analyze performance indicators that tenders, investors, and partners consider when assessing your business. These advanced insights will equip you to assess risk, plan major investments, and strengthen the financial resilience of your agricultural enterprise. To help you navigate the financial concepts in this section, this table outlines the main tools you will encounter. It shows their relative complexity, their role in managing your farm finances, and how often you are likely to use them in day-to-day operations or strategic planning. The key idea here is that financial management is not a single activity. Instead, it develops throughout the stages. At the basic level, tools like cash flow tracking and budgeting provide day-to-day and seasonal visibility. These tools help answer simple but critical questions. Do we have enough cash to cover expenses? Are we prepared for upcoming costs during the season? Well, as operations grow, intermediate tools become more important. Balance sheets and profit and loss statements shift the focus from short-term cash movement to overall business performance and financial health. These tools help managers to understand whether the farm is actually building value over the time or not. At the advanced level, financial analysis becomes more strategic. Liquidity and solvency ratios are not used every week, but of course they are essential when making major decisions, such as while applying for funding, taking on debt, or planning long-term investments. These tools help to assess resilience, risk, and long-term stability. The most important take away from this table is that financial tools are meant to support decisions at different moments. Not every tool needs to be used constantly, but each one plays a specific role in helping farm managers to move from basic financial control to strategic financial leadership. Well, financial management is not just an administrative task, but instead it's a strategic pillar of agribusiness success. By mastering these concepts, you will be better equipped to handle risk, improve profitability, and grow sustainable, resilient agricultural enterprises. This section focuses on the foundations of farm finance and introduces financial statements and ratios in a very practical way. At its core, running a farm is no different from running any other business. Money flows in, money flows out, and the goal is to ensure that at the end of the season, the business is financially sustainable. The challenge is that it's often difficult to judge how well a farm is performing if decisions are based only on memory, experience, or gut feeling. Financial tools provide a clearer picture. They help to translate everyday transactions into information that shows where the business started and where it is heading towards. And the important thing to remember is that these tools are not as complicated as they may seem. Of course, when used in a correct manner. Instead, they are practical tools that support for better decision making, not abstract accounting exercises. Well, let's begin with what are financial statements and why do they matter? A useful way to think about financial statements is to see them as health reports for your farm. Just as a medical checkup tells you how your body is doing, financial statements tell you how your farm business is performing. One of the most important of these is the income statement. This is often called the profit and loss statements as well. This statement looks at a specific period of time, usually a season or a year, and compares how much money came in with how much money went out. If income is higher than expenses, then the result is a profit. If expenses are higher than income, then the result is a loss. While the idea is simple, this statement is powerful because it shows clearly whether the farm's activities are actually generating a value. Even profitable farms can run into trouble if money doesn't arrive when they need it. The cash flow statement shows when money actually enters or leaves your account. It helps you to plan if you can pay for your bills on time, for example, especially during tough months like early spring. Another key financial statement is the balance sheet. While the income statement looks at performance over time, the balance sheet shows the farm's financial position at a specific moment. It answers three basic questions: what the farm owns, what it owes, and what is left once obligations are taken into account. Assets include things like land, machinery, livestock, and crops in storage, everything that has value within the business. Liabilities represent obligations such as loans, outstanding supplier bills, or other debts. The difference between assets and liabilities is equity, which reflects the true underlying value of the farm. A strong balance sheet matters because it affects credibility and future options. Farms with solid equity positions typically find it easier to secure financing, attract partners, and plan long-term investments with confidence. Well, in terms of financial ratio, it helps turn numbers into meaning. A useful way to think about them is to compare financial statements to a soil test. A soil test gives you measurements, for example, pH, about pH levels, nutrients, organic matter, but those numbers only become useful once they are interpreted by. Financial statements work the same way. They provide you raw figures, but ratios help to explain what these figures actually say about the health of the business. Ratios don't add new information. Instead, they reveal the story behind the numbers, helping managers to understand performance, risk, and financial stability in a more clear manner. In terms of liquidity, these ratios help to answer one very simple but critical question. Can the farm pay its bills when they are due? Farming income and expenses rarely arrive at the same time, so having enough money for short-term resources is essential to keep the operation running smoothly. One common way to assess this is with current ratio, which is what the farm owns in the short term, such as cash or money expected soon, divided with what it owes in the near future, like unpaid bills or short-term loans. If the current ratio is above 1, it means you can pay your upcoming bills. However, if it is below 1, you may be at risk of running out of the cash when you need it most. For example, if a farm has 10,000 euros available and 8,000 euros in upcoming obligations, the current ratio is 1.25, so the situation seems manageable. There is enough liquidity to cover the upcoming expenses. But if available cash drops below short-term obligations, say 6,000 euros against 8,000 owed, the ratio is 0.75. That's a warning sign. It doesn't necessarily mean that the farm is failing, but it does mean action may be needed to avoid cash shortages at critical moments in the season. In simple terms, liquidity ratios help farmers spot cash flow risk early before they turn into serious problems. Well, in terms of profitability ratios, they answer a very straightforward question. Is the farm actually earning enough from its activity? One of the most useful measures here looks at how much of the farm's revenue remains once all costs have been paid. The net profit margin equals with the net profit divided by the total revenue. In simple terms, it shows what share of each euro earned is kept as profit. If that share is relatively high, for example 20%, let's say, the business is retaining a healthy portion of its income. However, if it is much lower, like 5%, it means that most of the money coming in is being absorbed by cost, so it's leaving little room for investment, risk, and unexpected shocks. Profitability ratios help farmers to understand not just whether they are busy or productive, but whether their activities are truly generating sustainable returns. So, in terms of return on assets, this looks at how efficiently a farm is using what it owns to generate profit. The return on assets equals with profit divided by the total assets. Instead of focusing only on income, this ratio asks a deeper question. Are land, machinery, buildings, and equipment actually working hard enough for the business? For example, imagine two farms earning the same profit of 30,000 euros. If one farm achieves that profit using a smaller base of land and equipment, while the other needs far more assets to earn the same amount, the first farm is operating more efficiently. Return on assets helps managers to see whether growth should come from better use of existing resources rather than from buying more land or machinery. Well, in terms of solvency ratios, they tend to focus on long-term financial stability. They help answer an important question. Is the farm carrying a level of debt that it can be realistically sustained over time? One way to assess this is by looking at how much the farm owes compared to what it owns. When debt makes up a large share of the business, the farm becomes more exposed to risk, especially if interest rates rise, markets weaken, or a poor harvest reduces income. Another useful perspective looks at how much of the farm's total value actually belongs to the farmer rather than the bank. A higher share of equity means greater financial security and more flexibility when making future decisions. For example, a farm with land, machinery, and inventory worth €200,000 and debts of only €50,000 is in a relatively strong position. But if debts rise closer to €150,000, the business becomes highly leveraged, and decisions need to be made with much greater caution. Solvency ratios help farmers to understand not just whether the business can survive today, but whether it's financially resilient enough to face the future shocks. So here are a few practical reminders from the field. You don't need to be a financial expert to benefit from these tools. Reviewing a small set of key numbers once or twice a year is often enough to stay informed. The real value lies in using this figure to spot warning signs early before small issues turn into cash shortages or growing debt. And remember, financial tools are not designed only for bank or for accountants. They exist to support you as a farm manager, helping you to make more confident and informed decisions about the future of your business. Start simple, so track income and expenses on a monthly basis, then add one ratio at a time. You will soon feel more confident managing the business side of your farm. Well, once you are comfortable with the basics of budgeting and cash flow, it becomes essential to look deeper into how business performs over time. This part explores advanced financial tools that help you to measure and interpret the health of your farm with greater precision. You will learn how to calculate and use key financial ratios, assess solvency and liquidity, and analyze performance indicators that lenders and investors rely on. These tools are not just about numbers, they provide a roadmap for smarter decisions, whether you are planning a major investment, preparing for a loan obligation, or simply aiming to strengthen your farm's long-term resilience. By mastering advanced financial analysis, you will gain clearer visibility of your risks and opportunities, and of course be better prepared to guide your agricultural enterprise towards sustainable growth. Well, a good financial statement system, in that case, is like a health check for a business. Relying on intuition alone often leads to poor financial decisions. There are a few financial documents that every farm business should be familiar with. The income statement looks at performance over time by comparing income and expenses. It helps to answer a very direct question. Is the farm actually profitable over the season or year? The cash flow statement focuses specifically on cash movement. It tracks when money actually comes in and when it goes out, which is crucial because a business can appear profitable on paper and still struggle to pay its bill. Together, these documents provide a clearer picture of both profitability and liquidity, helping farm managers to understand not just whether the business is earning money, but whether it has the cash available when it is needed most. Now, let's look at a practical example that shows why financial statements need to be interpreted in a careful manner. Dimitra runs a 12-hectare mixed farm producing olives, seasonal vegetables, and table grapes. At the end of the year, her income statement shows a healthy net profit of 28,000 euros. Based on that number alone, her farm appears financially successful. However, by early spring, Dimitra finds herself struggling to cover essential operating costs such as fertilizers, irrigation maintenance, and part-time labor. Well, what went wrong? A closer look at her cash flow statements tells the real story indeed. Although she made several bulk sales during the autumn harvest, the payments from buyers, particularly wholesale distributors and export clients, were delayed by 60 to 90 days. That means while the income was recorded on paper in October, the actual money didn't arrive in her bank account until January or February, after critical expenses were already due. Meanwhile, Dimitra still had to pay for field, irrigation, greenhouse repairs, and upfront seed purchases in December. Because her income was tied up in unpaid invoices, her account balance was nearly empty during the most demanding part of the production cycle. So she had to take out a short-term personal loan at a high interest rate just to keep the farm running, eroding part of the profit she had recorded at earlier time. This scenario illustrates why relying on an income statement is not enough. The cash flow statement helps to uncover liquidity gaps, timing mismatches, and short-term financing risk. If Dimitra had reviewed her cash flow projections in advance, she could have negotiated shorter payment terms with clients, set aside a cash reserve during the harvest season, arrange an early season line of credit with her cooperative bank. The key lesson here is that even profitable farms can become financially fragile if cash inflows don't align with outgoing obligations. Cash flow visibility is essential to avoid costly surprises and make smarter financial plans throughout the year. Well, now let's look at balance sheet. Balance sheet is a financial statement that provides a snapshot of what the farm owns, assets such as land, equipment, inventory, and what it owes, such as loans, payables, as well as the amount of owner equity. It offers critical information for assessing the farm's overall financial strength and stability. Well, a central concept here in farm finance is equity. Equity represents the portion of the business that truly belongs to the owner. To understand it, think of the farm as a combination of everything it owes and everything it owes. When outstanding debts and obligations are subtracted from the total value of land, machinery, livestock, and other assets, what remains is the equity. This figure reflects the owner's real financial stake in the business, and it's a key indicator of long-term financial strength in agribusiness. This table is an example of balance sheet in agriculture business. Let's make some quick observations. So assets are made up of cash, inventory, land, buildings, and equipment. Liabilities are loans and money owed to suppliers. And equity is what the owner truly owns after all debts. So assets equals with liabilities plus equity. Financial ratios allow agricultural entrepreneurs to interpret complex financial data and evaluate the health of their operations quickly and effectively. Understanding key ratios provide valuable insights into liquidity, profitability, and solvency, which are the three pillars of financial stability. Well, liquidity ratios are about short-term survival. Liquidity ratios measure the ability of a farm or agribusiness to meet its short-term financial obligations as they come due. One of the most common liquidity measures, the current ratio, compares what the business has available in the short term with what it needs to pay in the short term. The current ratio evaluates a company's ability to meet its short-term obligations, typically due within 1 year. It indicates how effectively a company can use its current assets to cover its current liabilities, providing investors and analysts with insights into a farm's short-term financial stability. A ratio of 1 or higher suggests that a company is capable of meeting its short-term obligations, whereas a ratio below 1 indicates potential difficulty in covering these liabilities. The quick ratio, sometimes called the acid test, is a structured way of assessing liquidity. The formula for the quick ratio is current assets subtract inventories divided by current liabilities. A value above 1 is generally desirable and indicates that the farm could meet its immediate obligations even under pressure. Well, profitability ratios focus on how effectively a farm turns its work and inputs into financial returns. In simple terms, they have to answer the question: after everything is paid for, how much does the business actually keep? One of the most useful measures here looks at net profit in relation to total revenue. Instead of just showing whether the farm made money, this ratio shows how efficiently revenue is converted into profit. Higher margin means that costs are being controlled well and that a larger share of sales is retained by the business. A low margin, even when sales are high, signals that expenses, interest, or other costs are absorbing most of the income. For farm managers, this ratio is especially valuable when comparing different enterprises, production systems, or seasons. It helps to reveal not just which activities generate revenue, but which ones truly contribute to long-term profitability. Well, return on assets shifts the focus from profit alone to efficiency. It indicates what percentage of revenue remains as a profit after all expenses are deducted. A higher margin suggests better cost control and pricing strategies. Net profit margin measures how much profit a business generates relative to its total revenue, indicating how effectively the farm's assets are being used to create earnings. It's typically expressed as a percentage, but can also be represented as a decimal for analysis. Solvency ratios assess the farm's ability to meet its long-term debts and obligations, indicating financial endurance. The debt-to-equity ratio is a key financial indicator that shows the extent to which a farm or agribusiness relies on borrowed capital compared to owner investment. It reflects the balance between borrowed funds and the owner's investment used to finance operations and growth. A lower ratio generally indicates lower financial risks. Equity to asset ratio measures the proportion of the farm's assets financed by the owner's own funds rather than the external debt. The lower the ratio result, the more debt a company has used to pay for its assets. Financial ratios make it easier to interpret complex financial data. In this table, we summarize the key ratios, which includes current ratio, net profit margin, debt to equity ratio, and return on assets. Here is what we have learned. High liquidity strengthens short-term stability. Enduring farms can withstand seasonal income gaps or emergencies. Strong profitability ratios show efficient management and the potential for reinvestment and growth. Solid solvency ratios build resilience, improve access to credit, and protect against over-leveraging in volatile markets. Regularly monitoring and analyzing these ratios allows agriculture entrepreneurs to make informed decisions, benchmark progress, and secures financing or investment when needed. Well, let's explore an example of using financial ratios to diagnose weaknesses in a vineyard business. Maria and her sister run a small vineyard in Western Crete, producing bottled organic wine. After a successful tourism season, their sales reached 120,000 euros. At first glance, the business seems to be in excellent financial shape. However, when preparing to apply for funding under a CAP-supported sustainability program, their advisor asked for a financial analysis. That's when they begin to explore their financial ratios. Well, liquidity ratios are as follows. So current assets equals to 40,000 euros. Current liabilities equals to 50,000 euros. Inventories equals to 25,000 euro. And the current ratio is 0.8. Here, a ratio below 1 signals that they may struggle to meet short-term obligations. In fact, they are behind on 2 supplier payments. The quick ratio is 0.3. So when removing inventory, this means bottled wine not yet sold, the situation looks worse. Only 30 cents of highly liquid assets for every 1 euro of debt. The liquidity ratios expose a key risk. Their working capital is too tight. Despite selling well, cash is not available when needed. Profitable ratios are as follows. So net income is 14,000 euro. Revenue is 120,000 euros. Total assets equals to 185,000 euros. And net profit margin equals to 11.6%. For every euro of wine sold, they keep just over 11 cents. That's a decent return in agriculture, indicating effective cost control. If we look at return on assets, it's 7.6%. Their assets are generating a modest return, but there may be room for more productive use or diversification. In terms of solvency ratios, total liabilities equals to 90,000 euro. Owner's equity equals to 95,000 euro. Total assets equals to 185,000 euros. Debt to equity ratio equals to 0.95. So almost 1 euro of debt for every 1 euro of owner capital. This is acceptable, but it suggests careful monitoring is needed, especially if interest rates rise. Equity to asset ratio equals to 0.51. It's just over half of the business is financed by the owners, so this provides a good cushion, but also means they are moderately leveraged. Well, although profitable on paper, Maria's vineyard is exposed to short-term liquidity stress, a risk that could be hidden without ratio analysis. By calculating this ratio, they realize they need to improve cash reserves or negotiate better payment terms with buyers. Profitability was healthy but could be boosted through better asset utilization, for example, through converting unused land into agritourism or solar energy, let's say. And their debt levels were manageable, but any new investment would need to balance carefully between growth and risk. Ratio analysis helped them to understand not just how much money they made, but how safely and sustainably their business was operating. Now let's move on to the strategies for managing risks. One of the most effective ways farms can manage risk is through diversification. Diversification means avoiding dependence on a single source of income. Instead of relying on just one crop or activity, the farm spreads risk across different products or services, such as cultivating different crops, developing value-added products, for example, turning milk into cheese, or offering agritourism services, thereby decreasing reliance on a single income stream. Insurance programs provide compensation for the losses due to adverse events. In the EU, many farmers can access subsidized insurance under rural development programs, covering crop damage, livestock disease outbreaks, or natural disasters like floods, droughts, or storms. Another important source of risk in agriculture comes from price volatility. Markets can change quickly, and the prices that look attractive today may fall sharply by the time products are sold. Price risk management tools help to reduce this uncertainty by allowing producers to secure prices in advance. Through arrangements such as forward contracts, future markets, or cooperative marketing arrangements, farmers can lock in unexpected prices before harvest or delivery. Another critical element of risk management is financial preparedness. Agriculture is full of unexpected events, weather damage, machinery breakdowns, sudden price drops, or delays in payment. Maintaining cash reserves or access to revolving credit lines helps to manage unexpected crises without sacrificing operations or investments. Digital farm management tools plays an increasingly important role in modern agricultural business. These tools help in bringing financial and operational information together in one place, making it easier to track performance, plan ahead, and respond quickly when conditions change. Farm accounting applications, cloud-based record systems, and enterprise resource planning systems streamline tracking, forecasting, financial monitoring, and facilitate quicker decision making. A structured risk assessment process helps agricultural businesses to move from reactive crisis management to proactive planning. The following steps outline a simple but effective approach to identifying, analyzing, and managing risk in any type of farm or agribusiness operation. Start by identifying all possible risks that could disrupt your business operations or reduce income. Well, these risks typically fall into 5 categories. So, production risks, for example, due to drought, disease, or equipment failure. The second risk is market and price risk. So, for example, falling commodity prices, rising input costs, contract cancellations. The third risk is financial risks, and this is about cash flow shortages, loan defaults, and interest rate increases. Legal and regulatory risk. This occurs due to changes in subsidies, land use laws, and environmental compliance. And the last one is about human and operational risk, and this includes labor shortages, health problems, and succession planning issues. So risk identification can be done through team discussions, historical records, expert input, or benchmarking against similar enterprises. In step 2, you can evaluate how likely each risk is to occur within your business context. You can use simple ratings such as high, expected once a year or more, medium, like expected every 5 years, low, like unlikely or but possible ones. You can also draw on past data or industry reports to support this assessment. So, for each identified risk, you can consider the potential consequences. So, you can think about both financial impact, for example, loss of revenue, increased costs, capital damage, operational disruption like delays, reputation loss, or loss of market access. And you can use a scale from low to high. High includes severe impact on income or operation. Medium indicates moderate disruption, which can be manageable with effort, and low indicates minor inconvenience or cost. At step 4, you can combine the probability and impact ratings to focus on the most serious threats. Prioritize the risk. High probability, high impact risk should be addressed first, while low priority risk can be monitored but may not need immediate action. A simple risk matrix can help to visualize this prioritization. Top right quadrant indicates the urgent and important risk, whereas bottom left quadrant indicates the low priority risks. Well, the final step is to develop contingency and mitigation plans. For each high priority risk, you can outline concrete actions to reduce its likelihood or limit its impact. Common strategies might include like avoiding the risk, so for example, not growing highly sensitive crops in drought-prone area. The second strategy includes reducing the risk. So, for example, using pest-resistant seed varieties or securing of farm income. And the third strategy might include like transferring the risk, so having insurance, contracts, and diversification. And the last strategy might involve accepting the risk when cost of control exceeds potential impact, but plan is in place. You can document responsibilities, timelines, and review periods for each mitigation plan. Well, performing risk assessments regularly at the start of each season, after major changes or during business reviews, transform uncertainty into a manageable and strategic element of business planning. It improves financial resilience, supports better decision making, and is increasingly required by investors, certification schemes, and insurance providers. The risk assessment worksheet is designed to help farm managers and agri-entrepreneurs to perform a basic risk assessment. They can use this tool to identify key risks, evaluate their likelihood and impact, and plan appropriate mitigation strategies. It can be revisited seasonally or after any major operational change. The first step here is to list the potential risk under the categories of production risk, market risk, financial risk, legal or regulatory risk, human or operational risk. Well, once risks have been identified, the next step is to evaluate and prioritize them. Note that not all risks deserve the same level of attention. Some are unlikely to happen, while others may be rare but highly damaging. This table provides a simple structure for thinking through that process. Each risk is first described clearly so everyone understands what is being assessed. Then two key questions are asked. How likely is this risk to occur? And how serious would the impact be if it did? The priority level emerges from this comparison. A risk that is both likely and severe should be addressed first, of course, while lower priority risk may only need contingency planning or regular review. Notes and examples help to capture context, such as seasonal factors, past experiences, or links to specific enterprises on the farm. Once high priority risks have been identified, the next step is to decide how they will be managed. This is where analysis turns into action. For each major risk, the focus shifts from what could go wrong to what will we do if it does. Effective mitigation plans are specific and practical. Each plan clearly identifies the risk, outlines the strategy for reducing or managing it, and assigns responsibility to a specific person. While timing is also critical, setting clear timelines and review days helps to ensure that plans remain relevant as conditions change. Okay, let's continue with common financial mistakes in agriculture. One of the most common financial mistakes in agriculture is confusing profit with cash flow. A business may show a profit on paper, but still struggle to pay bills if income is delayed or poorly timed. Profit reflects long-term performance, while cash flow determines daily operational capacity. Failing to manage this difference can lead to shortfalls, especially planting or harvest seasons when expenses are high. Another mistake is ignoring seasonality. Many farms have irregular income flows depending on crop cycles or livestock sales. Not accounting for these fluctuations can leave business unprepared during low revenue months, increasing reliance on short-term loans or credit, which often come with high interest rates, unfortunately. Underestimating costs could also be a financial mistake. Agricultural operations involve both obvious and hidden expenses. Beyond seeds, fertilizers, and fuel, many overlook costs such as machinery repairs, insurance, interest on loans, or social security contributions for their workers. This can lead to budgeting errors and financial stress. Another very common financial mistake in agriculture is poor or inconsistent record keeping. Incomplete or disorganized financial records make it difficult to analyze farm performance, plan for the future, or present credible financial data to banks, investors, or government programs. Without having reliable data, it's nearly impossible to make informed decisions or access support. Well, avoiding these common financial errors is essential for building long-term resilience in agricultural business. Practices such as accurate forecasting, consistent bookkeeping, and paying attention to seasonal and less visible costs make a real difference over time. When farm managers understand where money is coming from, where it is going, and when pressures are likely to arise, they are better equipped to maintain stability, improve profitability, and plan confidently for the future. In this way, management becomes a foundation for sustainable growth. When we close this lesson, a few key lessons stand out. First, maintaining strong financial records is no longer optional in modern agriculture. Clear, reliable records improve access to loans, grants, and investment opportunities, and they strengthen credibility with banks, partners, and institutions. In today's agricultural sector, financial discipline is not just good practice, instead it's a real competitive advantage. Budgeting also plays a central role. It supports realistic goal setting, helps to allocate resources more efficiently, and reduce the risk of unpleasant surprises during the season. A well-prepared budget turns intentions into actionable plans. Finally, risk assessment brings everything together. By identifying and managing risk at early stages, farms reduce vulnerability to shocks, avoid catastrophic losses, and build long-term resilience. Taking together, these practices empower agricultural businesses to move from reacting to challenges towards shaping their own future with confidence and control. Well, risk assessments plays a crucial role in strengthening agricultural business. By identifying vulnerabilities early, farms can reduce exposure to shocks, avoid catastrophic losses, and build long-term resilience. Transparent financial management also matters beyond farm gate. Clear and consistent financial practices build trust with buyers, partners, lenders, and regulators, creating stronger and more valuable business relationships. Most importantly, developing financial literacy allows agri-entrepreneurs to move beyond day-to-day survival. It enables a shift toward a strategic thinking, informed decision-making, and purposeful growth. Together, these capabilities transform financial management from a defensive necessity into a powerful tool for long-term success in modern agriculture. This is the end of this part. Thank you for listening. We will come up with the following parts.